Hello guys, I just wanted to create this quick video to talk about why I think ETH is going to 30,000, why I think it's inevitable, and what I think some people are missing about this. I think that there's too many people focused on the technicals. They're focused on short term, and they're trying to they're looking at their own portfolios and they're thinking like, oh man, well if this goes up 10x, then I'm going to be so rich, and so like that's kind of the limit of what can happen in the bull market, and 30,000 is like unreasonable. But I think that Arthur Hayes' recent article, Time Signature, which we're going to go over, really shows you how the machine runs and how fiat is printed, and can give you a sense for the caliber of the money supply increase that's coming, and how that's going to create unreasonably high returns, specifically in crypto, for reasons that I'll go into. And the market doesn't actually care what your portfolio looks like, right? And it's when a huge wave of money comes in and there's a massive amount of debasement, then the numbers are going to get high. It doesn't necessarily mean you got as rich as you thought you did, but I think 10 to 30,000 in Ethereum is actually pretty reasonable considering the amount of money printing that is likely to occur. So just to kind of reiterate that, like, people are stuck on the technicals and they're kind of missing the scale of the coming debasement. And I think this article really kind of helps people understand how it's possible for the government to print trillions and trillions of dollars. They're too busy kind of stuck with these, looking at prior cycles, looking at the statistics and numbers around prior cycles. But each one of these cycles has really distinct phases. And the first couple cycles were entirely retail driven, and the last cycle was driven by extreme money printing. And we're probably going to see that again, right? With institutions coming in, and perhaps most importantly, Bitcoin and crypto being used as a way to continue the debasement, to continue the cheap money game, and to continue that government kind of grift that goes on. So if you haven't read the article Time Signature, I highly recommend you do. It's kind of interesting how so few people consume written content compared to actually consume videos, right? So if it's not in video form, it doesn't mean it's not worth your time. And there's only 210 likes on this video, on this article, excuse me, and there's 4 comments, right? This is actually a really important article. I think everyone should read to understand kind of what's going on under the hood in terms of the economy, in terms of what the government is planning for crypto and planning for this whole cycle of debasement that's coming. So a couple of core points out of this article. Arthur Hayes believes that we're headed toward 1 million Bitcoin and 10K plus Ethereum. He believes, and I think this is a very interesting point, is that Bitcoin is actually a vehicle for the regime to enable debasement, enable another cycle of debasement, and that stablecoin issuers will actually be one of the groups that steps up to buy T-bills and buy treasuries and continue, let the party keep going, right? Perpetuate the party. And a lot of the pro-crypto policies we've seen are actually in service of, keeping the government spending going. So let's kind of dive into one example here that's mentioned in the article, okay? And this will give you kind of a sense for how the machine is kind of operating, the government machine, along with corporations and along with banks, and how they operate to create basically more money printing for national goals or for the goals of whoever's ruling the country, right? So in this case, you have like MP Materials. It's a rare earths mining company. I think it's based in like Nevada, but it was basically just designated like a week ago as a critical infrastructure because the US is trying to diversify away from reliance on Chinese rare earths. Okay, so the Department of Defense actually made a $400 million investment into the company, and they want to create a new rare earths mine, a new rare earths operation, which is like 10 times bigger than what they currently have. And so now you have this like critical piece of infrastructure, and you can now I'm going to kind of describe how Arthur Hayes connects this to the debasement that's coming, right? So I want you to imagine kind of a situation here where, and by the way, this is actually a real example, although I'm not sure if I got, all the details here are exact, but if you read the article, you see that this is actually happening to some degree. So the first kind of step in the NP Materials story when it comes to like actually monetary debasement is NP Materials is going to build this new 10x facility, right? But they need financing to do that. Okay, the DoD has already said like, we're going to make this $400 million investment, and you're going to go ahead and do this so we can diversify from Chinese rare earths. And so they take a loan from JP Morgan, okay, in this example. So then what JP Morgan can do is they can pledge that loan that they originated for MP Materials, and they can pledge that to the Fed, okay, in exchange for reserves. Okay, so they take that loan, they pledge it to the Fed, and they receive a reserve balance in return. Okay. Now what JP Morgan can do is they have reserves in their account at the Fed, okay? And now they can go out and they can buy treasury bonds. They can buy treasury bonds that the US is issuing, and proceeds from those treasury bond sales will go to purchase MP Materials rare earth products. Okay, so it's like a circle, right? MP Materials takes a loan, JP Morgan pledges the loan to the Fed, okay, and then buys treasury bonds. The treasury bonds go back as investment back into MP Materials, okay, and that creates a money printing loop. Okay, there's not a lot that's capitalistic about this. This is basically like a socialistic kind of way of operating the monetary system, right? Because every part of this interaction is all through favored entities that can't fail, and they're just working together basically to create this system for national defense. So what happens is when MP Materials takes that loan to build that facility, that's a new money being created, okay, into the economy. Okay, and then MP Materials, they go out and spend that, right? They spend it on salaries, they spend it on new investments, they spend it on factories, they spend it on, other goods and services they need to basically run their business, run their materials, rare earth materials like operation. Okay, so that money enters the economy. Okay, and that actually creates inflation that hits the economy and increases the money supply. And this is what Arthur Hayes is calling a wartime economy. Because what's happening here is that the federal government is actually, they're funneling money into favored industries, okay, through various schemes by calling them favored, industries so they can loan more. And basically, it's a way for them they're printing money into the system to achieve different national ends, right? So it could be rare earths, it could be AI, it could be semiconductors. But any of these critical industries, they give the government the freedom to print a lot of money and hand out to all of these companies that are favored by the government. So it's not really capitalism, it's basically just socialism. And, it may or may not advance the national interest, but it definitely makes some corporations extremely rich with basically no risk. The only downside, the only person here that's getting hurt is the consumer, right? Because they're getting all this inflation. Right, so if this was possible without there being any kind of balance that to check the system, then they would, this would be official government policy. But it's not, because ultimately it leads to consumer price inflation and price inflation for the entire country, the debasement of the currency. So through the various mechanisms of this wartime funding system that Arthur Hayes sees. He sees, $3 trillion in bank lending. He also mentions in the article, which is worth mentioning, is that Fannie and Freddie going public and having the ability to lever up could result in $5 trillion of new, issuance, as well as another thing he mentions, which is that bank purchases of treasuries could be greenlit as a way to just basically purchase more treasuries if there's an absence of investors. Could lead to about 8.9 trillion in being printed, right? So all of these different kind of wartime initiatives to keep the economy going and to get that debasement driving forward so that they can pay down debts and increase government tax receipts will potentially result in as much as $9 trillion in the next 4 years. So that is double what the COVID money printing bonanza produced, right? So the US basically, I don't know what you would call it, the favored groups, the people that are dominating the country, like they love to get this cheap money, right? They get it first, they buy assets, and then the debasement hits the average person. And so there's no way they're going to stop that party, right? There's no way they're going to stop passing that punch bowl around. And So that is kind of the 9 trillion that's coming, right? And that's what Arthur Hayes says. So let's just go ahead and quote Arthur here. Money supply, economic activity, and the government debt pile all grow. Everyone is happy, the plebs have jobs, and the financiers and industrialists have government guaranteed profits. If these fascist economic policies provide goodies for everyone out of thin air, then why isn't it already global economic policy of every nation? It's because it creates inflation, right? And that's the critical point here. And we're going to get into that a little bit more, which is how this pumps our bags and what it has to do with inflation, right? So how does it pump our bags? Arthur Hayes makes the point that essentially, the Chinese Communist Party, CCP, the Chinese government, they had this system of basically inflating asset prices and getting the average person into real estate so that they could engage in massive currency debasement to do industrialized policies and probably pay themselves a lot of money. And so what happens, you can see here on the left is, I believe that's land prices going up from 2001 to 2020. And you can see on the right, you can see the housing markets and which ones are most overvalued, and China's at the top. And that's because China, their way of keeping people satisfied and their way of keeping people kind of from being swallowed by all this inflation was to get them into housing, right? So people levered up super high on housing, and their paper wealth went up, and the wealth effect took effect, and people didn't revolt. They just went along with it because as long as the housing prices were going up, they were happy because they owned houses, right? And that was the Chinese model for kind of keeping people from revolting at massive money printing, right? While they went on and they did all their industrialized policies and built all these factories and built, highways and roads, and you could even say they built highways to nowhere. And I remember when I was in China, there were subway trains that just went into nowhere. You could ride them. I rode one, for example. I rode a subway line to the very end, and it was just desert. The last 45 minutes to an hour of the ride was just a subway going out into a desert. And then the final stop was nothing. It was a parking lot in the desert. And there were endless empty apartment buildings around. And so, there was obviously a lot of corruption, whatever was going on there. But the point is that people dealt with it. They were okay with it because their asset prices were going up, right? And the point that Arthur Hayes is making that you need to understand is that that's what Bitcoin and crypto is going to become for the United States, okay? So, as he mentions, right, in that comment about inflation, is like the plebs are happy, they're making more, their salaries are going up. They have now crypto in their 401k, they have crypto in their IRA, they have a little crypto on Coinbase, they have their XRP, they have whatever, right, in their crypto wallet on whatever, pleb exchange they use, like Kraken or Coinbase, and Coinbase is shilling these whatever tokens. And so people are invested in crypto, right? And as we've mentioned in prior videos, like this is kind of, people go out on the risk curve the more desperate they are. So as inflation goes up, they'll gravitate toward high risk assets, which is crypto. We've gone over this in multiple other videos, but that rising tide of kind of inflation, which is if you want to stay above the water, you need to get into risk assets. As crypto goes up, as Bitcoin is pushed into every little economic crevice that it can be pushed into to absorb the money supply, to absorb buy pressure, stablecoin demand is going to go up a lot because the demand for crypto will go up. As investors flood the market with stablecoins, the demand goes up, and then stablecoin issuers, they're able to back their companies with treasuries. So they can basically they're issuing dollar equivalents on treasuries, right? It's not dollars in the bank. Okay? So what that does is that gives stablecoin issuers the ability to just go in and hoover up all these treasuries that the government's printing all this money, right? But they created all these pro-crypto policies. So crypto's going up really fast. So there's a huge demand for crypto. There's a huge demand for Bitcoin. That drives stablecoin demand, okay? And the stablecoin companies hoover up the treasuries, and the process continues, right? Process of debasement continues because there's still a buyer. There's still buyer for treasuries, right? So they can keep the party going, Okay, this is important. So the point is really that Bitcoin and crypto, they're kind of that Chinese model of let's keep people from, people need to be on board. The investing public needs to be on board with this, right? Otherwise, they're not going to vote for us. And so this is kind of the next phase in Arthur Hayes' thesis, which is like, yeah, crypto's going to the freaking moon, because, and it's not like it's because retail demand. It's like because there's this enormous debasement cycle coming, and crypto's a big part of that, right? And I think that's what a lot of people are missing. They're like, oh, my cousin doesn't care about crypto anymore. It's like, well, the Department of Defense cares about crypto, and that's what's really different this cycle. And, so just to quote him here, like, on average, $1 of total crypto market cap increases, 9 cents finds its way into stable coins. This is a quote from Arthur Hayes. So let's assume that Trump does his part, propelling the total crypto market cap to 100 trillion by the time he leaves office in 2028. That's about a 25x rise from current levels. If you don't think that's possible, you haven't been around crypto long enough. That would create roughly 9 trillion in T-bill purchasing power from stablecoin issuers due to global inflows. So that's the thesis in a nutshell, right? Is people still haven't quite grokked this whole institutional shift toward crypto and why it's happening and why the powers that be are pushing so hard for crypto. It's because they need to absorb the treasury, the T-bills, so they can engage in this wartime economy of spend, build new industries, make us competitive with China. So yeah, a conservative estimate here, correct that. Like, this is kind of based on Arthur's numbers. It's just, it is what it is, but it's, it's kind of interesting, right? Like, from 2019 to 2022, we saw a 3 billion stablecoin market cap go to 187 billion market cap in stablecoins. So a 120 to 9 trillion stablecoin market cap is a 75x, which is actually comparable to last cycle. I don't think it will get that high, because that would kind of be like all the government issuance. So maybe it's like half that. So, conservatively speaking, you could have a 33x increase in stables. People think that's so much, but the level of debasement is going to be huge, right? So, this actually lines up with some other people and what they think about the crypto market cap and where it could go. Like Dan Tapiero, for example, believes that we're going to 50 trillion market cap in the next few years. So that kind of equates to a 40 to 50 trillion market cap by the end of the cycle. And that puts us on track to like a $30,000 to $40,000 Ethereum. I know people think that's crazy, but it's really not. So, that's kind of the points I wanted to make. And to leave you kind of with a quote from Arthur here, like, the coming Ether bull run is about to tear the market a new asshole. And I really believe this. I think that, as I've said in past videos, like, people are super offside and they think that retail needs to come in and buy this time, but ultimately retail is going to end up buying when the level of debasement gets to such a degree that they have nowhere else to go. And they're aping into Bitcoin to save their retirement. And the government is just getting all the treasuries and T-bills that it needs bought by stablecoin issuers. So this is this kind of cycle of debasement that I wanted to communicate to you guys. Like, this is the cycle of debasement. Think in terms of, think at the national level, think at the institutional level now, and don't think at the retail level. The 2017 ICO boom was like just a retail phenomenon. It was nothing like what's happening right now with crypto. So to go back and to try to use, for example, the 2013 cycle when there was like liquidity was so thin and we're talking about like 10,000 participants or whatever, such a small number of people. And then same thing with 2017, like you had retail people coming in, but there was only like 5 altcoins. And then comparing that to Bitcoin being dragged onto the world stage and being like a major asset for counterbalancing global monetary expansion is a totally different game. And so the numbers are going to get crazy again. And I think a lot of people are probably going to sell too early. Question is, what do you sell into when there's such a massive amount of debasement happening? So that's actually the interesting part, because I think at some level you just kind of realize like, yeah, Bitcoin actually is probably where you want to stay, Bitcoin and Ethereum. So Anyway, this is kind of my rant. I hope this was useful. If you haven't read this article, Time Signature, I highly recommend you go and read this article because it's very insightful. And this is what the TA guys are missing. Technical analysis guys, they're too stuck on priors, but like all that statistics and all that prior stuff, like that's not how the world operates. That's all backward looking. The world doesn't operate on statistics, and it doesn't operate on statistical probabilities of things happening. So just keep that in mind. You know, that's kind of why I think Ethereum to 30,000 is inevitable. I hope you guys found this interesting. If you did, please give me a thumbs up and subscribe to the channel, and I will see you next week. Bye-bye.